All right, forget the usual company history. Today, we're treating this like a crime scene. We're conducting a full forensic autopsy. We're going to crack open the books on a billion-dollar collapse to find the exact moment a pricing algorithm went rogue and how it torched an entire company. Let's get to it.
Okay, right out of the gate, here's the central mystery. On one side, you have the promise, what they sold to investors during the SPAC craze. They were projecting almost $10 billion in revenue and, a small profit of $9 million for 2023. But then there's reality. Revenue missed by a mile, and that little $9 million profit? Nope. It turned into a jaw-dropping $627 million loss. That's a $636 million black hole between the PowerPoint and the pavement. Our job today is to find out what exactly created that black hole.
So this is it. This is the question that drives this whole investigation. And look, we're not talking about a bad quarter or blaming a tough market. This was a systemic failure. How on earth does a supposedly brilliant AI, the very heart of the entire company, get the math wrong by $1 billion? That's what we need to figure out.
To get our answers, we're cracking open our first evidence locker. And we're going right to the source code of any business's health, the unit economics. The fundamental question is, were they ever actually making money on a single transaction? On a per-house basis? Let's find out.
Now, if you just glance at this, you might think, hey, a turnaround story. In the first part of the year, they were just bleeding cash on every single house sold, a negative 7.7% margin in Q1. But then, look, Q3 and Q4, the margin actually flips positive. Management was probably patting themselves on the back, claiming they'd fix the algorithm. But here's the catch. Look at the volume. They went from selling over 8,000 homes in Q1 to less than 3,000 by Q3. They didn't fix the model. They just stopped the bleeding by turning off the machine.
And this gets right to the heart of the problem. Yeah, sure, anyone can make money on a few deals if you're super selective, but that wasn't the plan, right? The whole point of their AI model was massive scale. Making a tiny profit on a couple thousand homes means absolutely nothing when your entire company, all those engineers, all that overhead, is built to handle 10 times that volume. It's like using a freight train to deliver a pizza.
And here's that paradox laid bare. It's actually kind of wild. In 2023, they have a contribution loss of $258 million, leading to a net loss of $275 million. Okay, makes sense. But the next year, 2024, they actually flip to a contribution profit of $242 million. The unit economics are, technically speaking, fixed, so they should be profitable, right? Wrong. The net loss actually got worse, ballooning to almost $400 million. How? Because the scale vanished. And that's the paradox. The only way they could make money on each house was to shrink the business so small it could no longer pay its own bills.
Okay, so dissecting the unit economics just leads us in circles. It's a dead end. So let's move on. We're opening evidence locker number 2. And this is where we find the smoking gun. This is the one metric that told the real story, in real time. The one indicator Wall Street totally missed: inventory velocity.
So inventory turnover is actually a pretty simple concept. It just measures how fast you're selling the stuff you own. In Q2 of 2023, the ratio was 1.51. Now, that sounds great, right? They sold more than their entire inventory in one quarter. But it was an illusion. They were just fire-selling old inventory. The real story starts in Q3. The ratio plummets to 0.68, and by Q4, it's down to a disastrous 0.45. The whole machine just seized up.
Let's put this on a chart, because just hearing the numbers doesn't really do it justice. Look at that. This is not a gentle slope, it's a cliff. In just 2 quarters, the core velocity of the business gets cut by more than 2/3. Now remember, this company sold itself as a liquid market maker. For them, this is a total, catastrophic failure. The inventory wasn't liquid, it was turning into concrete. So let's put it plainly. By the end of the year, they were sitting on a mountain of houses and selling less than half of what they owned each quarter. Think about that. When your entire business model depends on moving capital fast, and every single one of those houses is bleeding money every day in taxes, insurance, and interest, this isn't just a bad quarter. This is a death spiral.
Okay, so we've established the what. The unit economics were a mirage, and the whole business ground to a halt. Now we get to the really fascinating part, the how. What were the specific flaws baked into the code that made this AI completely blind to the disaster hurtling its way? The first fatal flaw is a classic mistake in data science. It's called the lagging indicator trap. Basically, the algorithm was programmed to set its prices by looking at home sales from the past 90 days. Now, in a flat, stable market, that's fine.
But in a market that was changing on a dime, with interest rates going through the roof, it was literally like trying to drive a race car by only looking in the rearview mirror. The data it was using was already ancient history.
So let's put a price tag on this rearview problem. The entire financial model, the whole algorithm, was built on one single critical assumption, that they would hold a house for an average of 45 days. Everything, every profit calculation, depended on that number.
But reality, as it often does, had other plans. As the market froze, the actual hold time for a house on their books swelled to 105 days. That's not just a miss, it's more than double the plan. 60 extra days where the clock is just ticking and costs are piling up. And those weren't just empty days. That cost was very, very real. An extra 60 days of carrying costs, we're talking interest, taxes, maintenance, it all added up to about $4,600 per house. That's a pure financial bleed that the algorithm was completely blind to. It wasn't even part of the equation.
Just think about what that means for a second. On a house where they were hoping to make, say, $20,000 in profit, that $4,600 oops just wiped out nearly a quarter of the upside. And remember, that's before they had to start slashing prices just to get the house sold. The model was fundamentally broken by the simple, relentless passage of time.
Okay, that's one flaw. The second one is even deeper. It's more structural. It's a classic economic idea called adverse selection. All it really means is that the seller always knows more about what they're selling than the buyer does. And in this situation, the AI was the dumbest money at the table. It was the least informed buyer you could possibly imagine.
Let me make this super clear. You, the homeowner, you know about the leaky roof, the neighbor's barking dog, the weird smell in the basement. The algorithm, it knows square footage and sales comps from 3 months ago. So if you get a cash offer from an algorithm and you know your house is kind of a lemon, what are you going to do? You're going to take that offer and run. The AI was basically designed to be a magnet for the worst houses on the market.
And this isn't just a theory. You can actually put a number on it. A Norwegian study that looked at this exact model found what they called a lemon tax, and it's huge. They found that once you account for this information gap, the seller knowing more than the buyer, the potential profit on a house plummets from almost 8% all the way down to just over 1%. It's a massive hidden tax for being the uninformed buyer.
So the evidence is in, and it's undeniable. A deadly cocktail of driving with the rearview mirror and actively buying lemons, it just doomed the model from the start. The autopsy is complete. Now it's time for the verdict and to pull out the 2 critical lessons that every single operator out there needs to take away from this disaster.
All right, principle number 1 is all about data governance. And it's simple. Your algorithm has to be smart about what it doesn't know. It's not enough to be good with the data you have. You have to program it to price in the risk of the data you don't have. The leaky roof, the weird neighbors. If your model isn't built to account for the unknown, it's not a tool. It's a time ball.
And the second principle is about understanding structural risk. If your business model involves holding expensive stuff on your balance sheet, whether it's houses or cars or anything else, then velocity isn't just some metric on a spreadsheet. It is your only defense against time. Because time is always working against you, creating costs that will eat your margins alive if you aren't moving fast enough. In these businesses, speed is risk management. Full stop.
And that wraps up our autopsy. The evidence is clear. This company wasn't just a victim of a bad market, it was a victim of its own flawed design, a failure of first principles. Which leaves us with one final question, a question for every founder, every operator, every analyst listening right now. What's the math error hiding on your balance sheet? What's the core assumption you've stopped questioning, just waiting for the market to prove it wrong?